Hey guys, Chris from Spectrum Education. Just wanted to give a quick introduction or outline, if you will, of where we're going with this portfolio hedging program. I wanted to take a little time and kind of show you a general outline and the steps that we're going to take going forward on the Patreon channel. So here we go. I wanted to kind of reiterate again the reason that we're doing this and kind of what we're looking to achieve. I've got a portfolio visualizer going here. I went back a little further. Instead of using TLT, which is what I did on the last video, I found this fund, VUSTX. This is, I think it's a Vanguard, long-term treasury fund, and its data goes back a little bit further. If we analyze these portfolios, we can get returns and all kinds of information, but what I want to really pay attention to is the drawdown. So I think this shows very well what we're trying to do. So this starts at 1993 and goes to the present. Here's 2000, 2002, 2003 time frame. That was probably the last, what I would kind of call a prolonged bear market that we've had. And these are not peak to trough drawdowns. These are actually month end numbers. So if we look at our 80-20 portfolio, which is the red one here, we're down about 35%, and that's monthly. Okay. 2008 was even deeper than that, but 2008 actually recovered fairly quickly. This one was more drawn out. So if we look at these numbers here, drawdown for portfolio 2, this is the 80-20 portfolio. In 2008, our drawdown was 40%, but we were underwater for 3 years and 4 months. Going back to the 2002 time frame, underwater for over 5 years. So that means your portfolio did not get back up to the level that it was at for 5 years. Now, I want you to imagine if you retire and you need to start taking income, when one of these events happens. So the point in doing this whole process is learning how to hedge. So when this happens, we actually make money, or at least don't lose any money, and we preserve your portfolio value. So that's what we're going to learn, and that's what we're going to do, is learn how to hedge to sidestep these big, huge downturns. We haven't had one in, it's been 2008, 2009 time frame, but that's why I feel like this is so important, because it's coming. We're going to have another one of these, no doubt about it. I've created this quick little PowerPoint, how to hedge your portfolio. So really there are 3 steps. The first step is we need to determine the proxy portfolio. And what I mean by that is, if you've got a portfolio of mutual funds and stocks and ETFs and whatever, your entire investment portfolio, we've got to be able to kind of drill that down into something very simple so we can hedge it. There's no reason to hedge every single investment. We can just look at it in general and use index type options to hedge it. Then the second step is we actually have to figure out how many puts to buy. And then the third is we generate option income to help pay for those puts. So it's a very simple process. We're buying insurance. Insurance is very expensive, but we're going to do some other stuff to help us pay for the insurance. And the goal is to not limit the upside. It's very easy to do this if you give up the upside and just kind of flatten it out. It's a lot easier, but this gets a little, you got to have some knowledge, and takes a little time and a little bit of effort to preserve your upside potential, but also hedge the downside. And that's what I'm going to show you what we're going to do. So here's how we determine our proxy portfolio. So the first step is to gather up all your statements. So if you've got a 401k, if you've got an IRA, if you've got regular investment assets that aren't in retirement accounts, all of that, aggregate it all together, okay, and come up with a number. What's your total investable assets? Then once you do that, we're only going to look at 2 categories. We're going to look at equity and fixed income. I don't care if the equity is international. I don't care if it's large, small, mid, real estate, commodities, anything. If it's not bonds or fixed income, then we're going to call it equity. So we're going to come up with a number. That might be 60-40. It might be 70-30. It might be 82-18. It doesn't matter. Whatever it is for you, that's your number. Okay. Then we're going to take your total value and multiply it by each of those percentages, and then we're going to break that down into 2 symbols, SPY and TLT. So here's an example. Let's say that you do that and your total value on your portfolio is $793,000. You determine you've got 84% in equities, and then you've got 16% in some type of fixed income and cash. Okay, we take the 84%, multiply it by the 793, we get $666,120. Now, we look at what the cost or the value of SPY is currently, and as of January 21st, it was $446. We divide that number, 666,000, by the price of SPY, and that's how many shares of SPY we equate to your equity portion of your portfolio. So basically what we're saying is, if we had to take every single mutual fund, ETF, stock, everything that you own, and convert that into just the S&P 500 ETF, which is SPY, all of that would be equal to 1,493 shares. Okay, 0.54, 1,493.54. Okay, very simple. Do the same thing with the bonds. We've got 793,000 total value. Multiply that by 16%. We get 126,000. Divide that number by what the price of TLT is, which is 143, and we come up with 887 shares. So the proxy for your investment assets, no matter how many you have, everything, if you do this process, you break it down to a certain number of shares of SPY, a certain number of shares of TLT. Okay? Very simple. Now, what we're going to do is we're going to have a model that with different asset levels and different allocations, and I'm going to go through and daily hedge that model so you can take those trades that I'm doing and apply it to your portfolio. Okay? So the next thing we have to do is we have to buy a certain number of puts. And I'm not going to get into the full details here, but I'm just kind of trying to give you an overview. So basically in this example, if we had roughly 1,500 shares, we would need 15 puts to totally hedge our portfolio. Okay, we're going to buy close to at the money or maybe slightly out of the money puts, and we're going to do it on a campaign, which means we're going to do it consistently the same way every time. Okay, and what we're going to do is, when I start this, I'm not going to do it all at once. I'm not going to go out and buy 15 puts. I want to diversify over time, so you buy a certain number per week, and then if you already know this about options, if you don't know this, I've got lots of classes that kind of give you the basics. But when we buy options, we want to buy options with more time, and we don't ever want to hold them until they expire, because that's when all the time premium, or not all of it, but the majority of it comes out right at the end. So we're going to buy a little bit longer dated options. In this example, we're going to buy 60-day options, and we're going to hold them until they hit 30 days, and then we're going to get rid of them. Okay, so they still work, they still function. We just don't want to hold them right up until they expire, because that's when we lose the most time premium. This might be adjustable. We might even buy 90-day and hold them to 60, because that would actually be a little bit better, but it makes it a little bit more expensive. So when we get into the models, we're going to work on this, and I'll show you more details about how that works. And then this is expensive, because here's the thing. If our portfolio is going up, these puts are going to lose money. And that's the way a hedge works. A hedge never makes money when what you're hedging makes money. They're opposite. They're non-correlating. So if our portfolio is doing well and we're making, 10, 12, 14% a year, whatever we want to make, and kind of the long-term average of a good stock investment portfolio, these puts are a drag. They're going to cost us against that. So what we have to do is we have to figure out a way to pay for these. Okay, and what we're going to do there is we're going to implement some options selling strategies. And not to get into the details here, but basically, depending on where the implied volatility level is and how it's trending, we use several different strategies. But for the most part, we're going to use index options. We're going to make these strategies very theta positive, which means we want the time premium to work in our favor. And we basically make money as long as time passes and the market kind of stays in a range. So I'm going to share a lot more details about the strategy inside the Patreon channel. So this is kind of meant to be an introduction. If this makes sense to you, if you want to learn more, stay tuned, and I'll be sharing more details. Thanks for watching, and I'll see you next time.